Please welcome Jane and Jay to the stage. Thank you.
Good morning, folks. We have a lot to get to. We're hoping to save 10 minutes at the end for some questions. I was out at the port early this week. We were talking about tariffs as the first ship came in from China since the tariffs hit. And only 12% of the containers on that ship were actually tariffed. The rest from China were not. Yet at the same time, the New York Fed estimates, economists there, that the average American household will spend over $800 this year because of tariffs. But most of that will not be because of the actual tariffs, but the costs being passed through as companies change their supply chain. So there's so much going on in the world. Are we in extra innings of an expansion? When does it go under? What are the risks and opportunities in the credit markets? And Jay's the perfect guy to talk about that. Yes, we expect genius insights from you.
Yep.
I know you have some slides, and we're going to work through them. I think we know the tailwinds, fear the headwinds, wildcards. The most intriguing thing to me here is high debt levels, low debt quality, which I guess is where you make your money?
Well, so on this slide, thank you for letting me putting it up here. We are all bombarded with everyone's opinions about what's up, what's down, what's sideways, what might happen. So I've always tried to keep a bit of a scorecard, and today I'm calling blowing in the wind. But basically, tailwinds for the economy and the markets, generally speaking, known headwinds for those, generally speaking, and what I call the wild cards. And this slide has changed somewhat over the last year. But, and in particular, before I get to some of the specifics, the biggest thing in my mind that's changed over the last year, if you go back a year, the word synchronized global growth, or that term, was pretty popular. It seemed like there was nowhere in the world where people weren't saying, want a pretty decent and improving growth trajectory. I think the Fed had raised rates twice in 2018, and they had signaled that there would be, I believe, 2 more rate increases the last half of the year. And depending who you were, 2 to 3 in 2019. Well, the fact is there wasn't another rate increase after that. And the Fed hit the brakes hard in December with
actually
Chairman
January,
Powell's
when his hand shaking as he reads the statement.
Yes, and so that has changed a lot of people's outlook. We also see risk-free rates declining again. We see the yield curve flat as a pancake, in some areas a little bit inverted. So I think that risk is less on, maybe it's even off versus a year ago. On the slide at Oaktree, probably 2 of the things we focus on the most, or 3 of the things, is the amount of debt that's outstanding, which is extremely high, the quality of debt that's outstanding, which relatively speaking is extremely low, and the fact that there's a lot of uncertainty about how much liquidity there really is in the market to move debt in size as needed. And we've seen some times where that came into play. The end of 2016, the end of 2018, some pretty dramatic moves in the credit market, a lot of it because of not as much liquidity. The whole world of banks being able to hold inventory and such has changed post global financial crisis. And we really haven't been tested, probably for close to 10 years, for a significant period of time. And so we follow that closely. In terms of, is it how we make our money? So Oaktree, I like to say, is a large, diverse, multi-strategy alternative investment firm. We have a number of counter-cyclical strategies and a number of what I call prosperity strategies. Probably what we're known most for is our distressed debt strategy and affiliated strategies. So we have opportunistic real estate, opportunistic corporate emerging market debt, by way of example. And certainly those strategies have continued to invest, but are also very focused on the possible expansion of investment opportunities.
Of all those
quickly.
strategies, what people in this room want to know, which show the most promise?
You tell me the environment, I'll tell you which show the most promise.
I know you hedge everything, but if you were a betting man, what would you say, this is the one I'm thinking is going to perform well over the next 12 months?
Yeah, I hate to be evasive, but It all depends on market conditions. One of the things we say at Oaktree is there are no bad assets. There are no good assets. They're just assets that can be acquired at different prices. And the fact is that it all depends on the price you pay, or mainly depends on the price you pay, versus what you think the intrinsic value is over a reasonable time.
All right, so let me throw out some scenarios. No more rate cuts, and we continue with the current tariffs, and I'm not even going to get into the presidential election yet, but sort of going forward that maybe the tariffs do not expand to everything from China, they stay where they are, rates stay where they are. What looks most interesting to you?
Well, let's look what's been happening in our industry. So, first of all, the alternative asset management industry looks interesting. It's been growing twice as fast or more than traditional long-only asset management. Why? Because rates are very low, and most of our clients, the largest pensions in the world, sovereign wealth funds, largest endowments, insurance companies with long-duration liabilities, the right sides of their balance sheets continue on 24/7, 365, regardless of rates, spreads, world affairs. They need a return. And they look to the alternative asset management industry, whether it be private equity, which has been a strong performer for 10 years, long and levered, whether it be opportunistic credit, including our distressed debt funds, strategic credit funds, mezz debt funds, the whole exploding world of what is now referred to as private debt, where people are in effect scrounging for 30, 40, 50 more basis points in exchange for liquidity, because publicly traded bonds are trading so tight. Real estate, I think all of those categories have done well and will continue to do well in this kind of an environment, mainly due to the demand side, which is it's hard to return what you need to 6, 7, 8% for the clients I referred to, which is what their actuarial and other assumptions say, by investing in bonds, publicly traded bonds, investment grade, non-investment grade, that are yielding 4, 5, 6%.
Howard Marks had mentioned that he's buying up Chinese non-performing loans cautiously. Explain where and what that strategy is.
Yeah, so we've been very active and could get more active in China, looking at non-performing loans. A couple of comments about China. Chinese economy is doing fine by our standards, but it is slowing down. And it's been such a growth engine for the rest of the world, especially the emerging markets, that the world feels that. Number two, the markets there, especially the debt markets, have grown dramatically over the last 10 years. And with very, very little increase in the absolute outstanding amount of either non-performing loans or what they call SML, special mention loans. And our view is that in just a normal cyclical slowdown, maybe even a recession in China, not a bubble bursting, not the end of the world, not something cataclysmic. If you apply the normal percentages of debt that are likely to become stressed or distressed against the outstanding par amount, you're going to see a dramatic increase in investment opportunities. How to take advantage of those. So at Oaktree, people find it surprising, we have more of our investment professionals involved in our distressed debt strategy located outside of the United States than inside the United States, either in Europe or China. But it makes sense. The US is pretty benign. The amount of tradable distressed opportunities here is very, very modest. There are some opportunities, but they are very bespoke. Meanwhile, we've spent a lot of time investing in Europe, as a lot of the banks there have slowly been cleaning up their balance sheets post-global financial crisis. But probably the place where we're seeing the most opportunities for growth, and we're doing it in a very controlled way, is in Asia and really in China, and probably a coming attraction is in India. We built partnerships with the largest asset management companies in China, with loan servicers in China, with banks, borrowers, and brokers in China. And so I think we've done 4 or 5 non-performing loan pools, so far performing well.
Yeah, I mean, what's the default rate? And what's the default rate? I don't. Do you trust that there will be a bailout? I'm trying to understand. For someone I'm an idiot. If you're buying non-performing loans in China, what is the downside?
Yeah, it's just like the downside here. you're purchasing loans, you're hoping and expecting, and we've gotten more and more comfortable that the legal system and the regulatory system will, as I like to say, honor creditors' rights. There are
Even foreign creditors.
Absolutely, absolutely. And I believe the Chinese very much want to see foreign capital coming into the country for various reasons, including this one. And the surest way to do that is to have a sound legal system that works in a fairly predictable way. And we've had good experience there. The quickest way to have capital flow out of the country is to have it be the wild, wild west and unpredictable. And I don't really see that happening with China. I think the thing that will probably create the most opportunity is, and I heard the last speaker talk about this, how much will the Chinese stimulate their economy and help basically extend loans, refinance loans. So much of the lending in China is through the state-owned enterprise entities. Really, if that slows down and businesses and assets have to be financed, in effect, on their own merits, as opposed to access to easy, low-cost money at the direction, to some extent, of government policymakers, I think you'll see the opportunity set increase.
Before we go to the next slide, you say down here the 2020 presidential election and a non-traditional U.S. president, which I think is the most politically correct way to describe the presidency. He is non-traditional. Let me throw out another scenario. We go into recession next year, and/or there's a change in administration. What strategies do you think have the most promise in that scenario?
Yeah. Well, I think all the strategies that focus on non-performing or stressed debt will see a huge increase in the opportunity set. The fact is that since the global financial crisis, for example, in the U.S., the size of the high-yield bond market and the leveraged loan market, so below investment grade loans and bonds, has more than doubled. I think the market, I have a...
Yeah, let's go to the, you want to go to the next slide?
Yep,
this is amazing.
Good.
Look at that.
So first of all, I've got a couple slides here. The gold line is the percentage of GDP that non-financial corporate debt is as a percentage of GDP.
That's amazing.
And you can see that it's grown significantly recently. The green line is the U.S. high-yield bond default rate. And historically, until 2016, the gold line and the green line were correlated. Makes sense. More debt, more defaults, indicative of the fact that probably more debt means debt quality is reducing during periods. But something odd is happening now. Much more debt, very benign default environment. Lots of different reasons for that. I think probably the primary one is very, very low-cost money brought to you by the central banks of the world, led by our Fed. Easy to lend and extend. And as a result, what we have seen is much more debt outstanding. The quality of the debt, be it defined by covenant protections, by the debt to intrinsic value ratio, has declined. A lot of the debt has been put on buyouts and M&A transactions that were done at high prices and that were done with, frankly, very, very liberal and aggressive modeled projections of future results, or as we like to say in the industry, EBITDA adjustments.
When does the green line go up?
Well, we believe at some point the two lines will be more correlated. That'll be an interesting scenario. The when, I don't know. I think it's been several years that our motto at Oaktree has been to move forward, but with caution. People ask, it's an impossible question, Howard Marks, where are we in the cycle? And Howard answers, I think we're in the 8th inning. And then somebody mentioned to Howard that baseball games do go into extra innings, and this one certainly has. Probably the longest recovery we've seen in the U.S. in quite some time. Now, of course, there are people that can explain it because they point to the fact that Australia has had a fairly uninterrupted recovery for 26 years, and so why couldn't the U.S. continue on like that? The answer is our job at Oaktree, on behalf of our clients, is to do the best job of investing we can in the environment that we see in front of us and to know where we are in the cycle. We do think we're late. We do think that risk-taking has led to very high prices and relatively low prospective returns. We are still investing. In every asset class, there's a more aggressive way to invest, and a less aggressive way to invest. Easy examples, high yield bonds. You can be more skewed towards double B and maybe single B plus bonds, or you can be more skewed to triple C and triple C minus bonds. And I think you'll see across most of our strategies at Oaktree, we've been skewed more towards the higher quality ends of the spectrum in each of our asset classes.
If we do go into recession, which sectors would be the most interesting to you?
Yeah, well, there'll be a lot of, let me just cover a couple more of what we call the kindling slide. So what I did on this slide, Jane, was if you look at the upper left, you just see the total size of the leveraged loan, the high yield bond market. And this is the one that shows basically it's more than doubled since the global financial crisis, just shy of $2.7 billion.
Shouldn't we be concerned?
We should be mindful and follow it and cautious.
Find opportunities.
Watch. The right side, upper right side, I think is extremely interesting. In addition to the growth in below investment grade debt, there's been huge growth, unprecedented, in the lowest rating category of investment grade debt, triple B bonds. So these green bars represent the fact now that the triple B corporate debt universe is roughly 55% of all investment grade corporate debt. And you can see the growth. And the reason that's important is if you go to the lower left, which is what might happen, I'm answering your question, sorry to take a long time to get there. What might happen if we go into a recession? Well, historically, if we go into a recession, among other things, you see a cycle of debt downgrades by the rating agencies. A fairly predictable cycle. And the bonds that are most likely to get downgraded are the lowest investment grade rated bonds, triple Bs. So what this slide shows is a number of things. The green bar, by the way, I can't see quite that far, so I'll take a look at my own slides. The green bar is the estimated size of what we call fallen angels, which are triple B rated bonds that fall to non-investment grade rated. The reason why that's important is a lot of the holders of triple B rated bonds cannot hold those bonds for regulatory, capital, and other reasons when they become non-investment grade.
Oh, okay.
And they become quasi-forced sellers, and we become happy buyers.
Yeah.
The other bars show defaulted bonds. And so what you see is the left side of each of those time periods is the universe of fallen angel bonds, defaulted double B and single B bonds, triple C bonds, and such. The right side is the amount of dry powder. There's a huge amount of dry powder in our industry for almost everything. Private equity, real estate, and private debt. But the fact is, we believe that in a recession, supply very much trumps demand. And so the dry powder, while huge, nominally, 171 billion as of the end of the first quarter, as estimated by Preqin, pales in comparison to what the supply side could look like in a recession. And a recession probably would do a lot of damage to the debt markets and provide a lot of opportunity.
It sounds to me like opportunities now are outside the U.S., but once this happens, the opportunities are inside the U.S. Am I getting that right?
I think the opportunities will grow dramatically around the world. The emerging markets, if we have the same slide, I didn't bring it, similar phenomenon, huge growth in the size of corporate debt issued by the emerging markets, a lot of which is dollar denominated, which poses another problem in a recession scenario. And I think you'd see dramatic stress there and increase in opportunities. But the opportunity set, I think, could grow dramatically. Even in this time, though, you mentioned earlier, where do you see the opportunities? And for us, it's mainly been private transactions in Europe, still some non-performing loan pools.
Can you give us an example?
Real estate-related non-performing loan pools coming out of European banks that are still in a bit of a cleanup mode. There's still opportunity there. That has slowed down a bit. Non-performing loan opportunities in China would be a good example. We've done our first 2 transactions in India, which has a similar market size situation as China, but I think is a little bit behind China, but getting there in terms of demonstrating to the global community that they have a sound legal system and bankruptcy system and reorganization system that will honor creditors' rights. And so that will open up. And even in the U.S., there's things to do now, real estate, retail, some telecom, but it's very much individual circumstances. It's not throw it against the wall as it might have been in 2008, 2009, when it seemed like there was stress in many, many sectors in the U.S. economy.
What would you not touch?
Depends on the price.
I mean, are there things right now that are just, we're just going to wait and watch on that, because that's just not,
Yeah.
I know you can't talk specifically, but we have all these unicorns coming to market and potential unicorns coming to market, which are high debt, not profitable. What's your thought on all the unicorns, without naming names?
Yeah, so full disclosure, that's not really part of our business at Oaktree, so I'm just sort of speaking as a guy reading the Wall Street Journal, I guess. But,
Smart guy reading the journal.
look, there's three things that affect stock prices. That's how I was taught. There's fundamentals, which people in this room are far beyond my capabilities at, things like earnings and price to book, price to earnings, various ratios. There's technical factors, overhangs, lockups, quarter end, option expiration, things I don't understand. And then there's the third thing that's the most unpredictable, human psychology. How are people feeling? Are people feeling confident or less confident? Certain or uncertain? In a mood to take risk, in a mood to take off risk. And all I can assume is that a lot of the unicorn activity we read about, some of the IPO activity we read about, is a demonstration of a lot of consumer confidence, of a bullish attitude about the future, of huge assumptions about the future. Because certainly at this point in time, you can't do a discounted cash flow model and ever assume most of these companies are worth even a small fraction of what their enterprise values are. So it's got to be a view about what the future will bring. Growth, margins, et cetera, and to each his own.
Before we open up for questions, what keeps you up at night?
Yeah. Well, work-wise, I was mentioning this to you earlier, very, very honored to be part of the Oaktree team. And we have about 900 employees. And from what I always like to say is probably if you're responsible for a business and in particular people, you should multiply the number of employees by somewhere between 5 and 10. And that total is really probably the number of lives you affect, good or bad. That has always kept me up at night. It's always got me inspired and excited to come to work in the morning. But that's the most important thing. Our people, their families, their friends and relatives, and the opportunities we can create for them, all on behalf of doing a great job for our clients. And that's what drives all of our businesses.
Sorry, I had one more question. Jeff Gundlach said yesterday he thinks yields have bottomed, and PIMCO said overnight that the credit markets have never been riskier. What are your thoughts on that?
Well, my first thought is that I always agree with Jeffrey, because we're the proud owners of a 20% stake in DoubleLine. And in all seriousness, are extremely positive, bullish on Jeff and his team. Jeff Sherman, Phil Barish, the whole group over there has done an amazing job, a long runway, and we want them to be successful. And I think Jeffrey's got a pretty nice demonstrable track record of calling it right. I'm not a big predictor. If this is the riskiest or worst debt markets we ever seen, just as likely tomorrow it will be even worse, or it could get better. But bottom line is our job at Oaktree, on behalf of our clients, is to be cognizant of where we are in the cycle, to be aware of it, but to not be market timers, to not be predictors or macroeconomic forecasters, but to invest in the most prudent way we can in this environment. We're not asset allocators. We don't go to cash to get conservative. When our clients give us assets to manage, they want it invested. At this stage in the cycle, as a general matter, we're moving forward with caution. We tend to be at the higher quality ends of the spectrum within each investment strategy that we invest in. We're willing to give up some yield and return in the short run, possibly, to avoid some losses in the longer term. We like to say at Oaktree that in many of our investment strategies, if we avoid the losers, the winners will take care of themselves. If you invest in debt at par, for example, there's only one direction the price of that bond can go, down. You can't get more than par, by and large. And so given that, we're cautious. and we are disciplined in how we deploy our clients' capital.
We have a few minutes for questions.
If you ask a question,
please.
we will not give you the microphone because I heard that incredible well. I'll repeat the question, though.
We'll want to give it
Well,
a
this
shot.
one.
All right,
We're gonna
prepare-
try it.
Assume the position.
So up until end of April, we heard positive news about trade war with China. And during the recent several weeks, things has changed a lot. And so I read Chinese news in Chinese. I can speak Chinese. And the WeChat, the Chinese Twitter, the kind of combined with also it's a combination of Facebook Messenger
Right.
and Twitter. In Chinese, it's like a war zone. It's people were calling about boycotting Apple in the fall because America banned Huawei. And so I'm curious, what have changed during the recent weeks? Your opinions about assets in China, and have you acted on those opinions?
Yeah. So thank you for that question. I should say Oaktree has a very big presence in China and a growing presence, and we all spend a reasonable amount of time there. I guess, frankly, I don't think anything has changed. Go back to my slide. It's been a wild card. We have tariffs in effect now. The only question is, are we going to have more tariffs and higher tariffs? I think it's pretty obvious that the United States means business in terms of what it's trying to accomplish, and so do the Chinese. And both have a lot of staying power. The current situation is not a positive for markets or economies globally. More tariffs will be more challenge. I don't really look at it at who's winning and who's losing. I think we're all going to lose. It's just a matter of how much if this accelerates. I'm still, like I hope everybody is, optimistic that some deal will be reached, and there'll be the headline of what the deal is, and then there'll be, the most important thing, the reality of what the deal is. And we better pay attention, and we certainly will at Oaktree, to the second. But this has always been an uncertainty. It's one of the reasons that we've been somewhat cautious at Oaktree. And I think that we'll wait to see what the actual outcomes are. But in the meantime, the tariffs that have been imposed have had an impact here in the United States and in China. And if some of the tariffs that have been announced and then in some cases delayed are imposed, that impact will be heightened.
I do wonder, though, about pushback and if there is sort of a boycott. I mean, I think Starbucks earnings will be the first place to look, how Starbucks is doing in China, how KFC is doing in China. Are people starting to boycott? And then do you suddenly get pushback at some point, like we don't want to deal? You know, I think there's something that might be there. It's just not there yet. You have not experienced any antagonism because you're American yet.
No, I think the answer is no. I think
Okay.
that we have good relationships. Again, I feel like we have far more in common with our colleagues in China, and they with us, than any of us can really relate to some extent with our leadership. You know, on the human level, everybody gets it. But there are important policies in place and policy issues, probably things I don't fully appreciate. We're all hopeful there will be a resolution, a quieting down. But for the moment, I think it remains an uncertainty, and probably an increasing uncertainty given the announcements of the last 4 or 5 weeks.
Another question? No. All right.
Thank you
Jay,
all.
thank you very much. I know you have a plane to catch.
Thank you. Appreciate it. Great. Thank you.
Thank you, Jay. And thank you, Jane.